Hello, everyone, and welcome to the Buck Stops here. I am Catherine Murray. Well, as we start out 2022, of course, front and center for all investors and certainly individuals at home as well is the inflation effects that we are all seeing and feeling. It is very real. We have seen energy up by about 31% year over year. Nat gas is up over 20%. Food is higher as well. And the question, of course, is whether or not this is transitory or whether or not it will be persistent for 2022. And what does that mean for interest rates and, of course, your money? Joining us now, I'm very pleased to have his perspective to share with you, is Richard Farr. He's the Chief Market Strategist at Merion Capital. Richard, great to be able to get you on air with me for our viewers. You're very well known and respected by the hedge fund and institutional investor community. So thanks so much for your time.
Thanks for having me on. This is great.
Great. And Richard, there's a lot to digest here in terms of what really is going on as it relates to CPI and PPI. We're seeing decade highs. What are you seeing right now in terms of whether or not this stays?
Well, what if I were to told you that all things held equal, constant, CPI is going probably close to double digits? And there's a reason.
Double digits. Double digits.
Could easily see 10% CPI. Yes, we could. And the reason is shelter costs. And we've done a lot of drill downs on shelter costs. It's been a heavy focus for us. We did a big report on it this week. In the CPI data, you have two versions of rent. You have actual rents that they're calculating. You also have owner's equivalent rent. Each statistic in the CPI data is roughly 3 to 4% year over year. Now, if you were to look at any of the apartment rental data that's out there, Zillow, or there's an apartment rent, there's a million of them. The typical rent is up 12 to 21%. Now, shelter is 37% of CPI. So, even if you were to say, all right, it's not going to get there, there's a lot of nuances to how this data is collected, different areas, maybe, like some people say San Francisco is still a very depressed market, so, maybe in the aggregate, it's only, let's say, 6%, right? You're talking about roughly, a third, 3/8 of CPI doubling. And yeah, so, it's not crazy talk to say that if the Fed doesn't get aggressive in hiking rates and taking down the balance sheet, then we could be approaching 10% CPI quickly.
Do you think that even if they become aggressive in rate hikes and pulling back the balance sheet, that they can prevent that from happening?
Well, I think, the shelter part, probably not. But the other stuff they can. You've got energy and energy derivatives are roughly 10% of CPI. Maybe they can start to, hit some of that. You are starting to see at the margin, it's very much at the margin, but some of the food commodities are starting to roll a little bit in the past month or so, in anticipation of tighter, economic conditions by the Fed, and also, to the extent that supply constraints matter, they are opening some of those up too.
And just to kind of, bring this home so we really understand the economic dynamics here, if they raise rates, why does that really combat inflation? Because it prevents demand?
Well, so if you want to get back to the kind of monetarist theory, things that Milton Friedman said, Milton Friedman argued that inflation is always a monetary phenomenon. And, when you take your monetary base and you increase it by $5 trillion in 1 year, and you give people PPP loans and zero cost financing, you get tons of demand. People just start, building decks and docks and, additions on their houses, garages, all these things. And so you just get money in the system and it's just, sloshing around and there's more money going around than there is things to buy. And one of the things we talked about on your program a year ago, you and I had this conversation, was some things have changed in supply and demand characteristics. And one of which that I think was very underappreciated a year ago was how much China went after its state-owned enterprises and started to cut excess capacity. They actually had layoffs in some of the state-owned enterprises and things. And at the margin, that's less supply. It's the cheapest cost supplier out there, and they're cutting supply. So, at the margin, the price of things go up. And so that was kind of wave one of the inflationary impact was that.
Richard, we're going to take a quick break and we'll be right back. We'll pick it up on that note. You know, Richard, you talked about the decrease in supply out of China that you noticed, and I should have said this at the outset, but you did call for inflation a year ago, and people weren't even talking about it. So, how did you really see this play out, and where do we go from here?
So, we saw inflation coming in a couple of waves. The first one was the supply impacts that we mentioned. And the second one was you're going to get very easy year-over-year comps. And, we talked about this last year, almost a year ago to this day. And I said at the time that within a couple months, we're going to anniversary negative oil prices. So imagine, you have oil at $60 at the time, whatever it was, and you're anniversarying negative 20. So your inflation delta is going to be massive. And nobody was calling for this at the time. So we just said, hey, we're seeing supply constraints happen. There's a lot of money printed in the system. Your year-over-year comps are going to get very bad, in terms of very high for inflation. We don't think this is priced into the market. So that was kind of our thought in January last year. Mm-hmm. So February, we started to see some very strange numbers coming out of the shelter data. So we had a call with the BLS. We said, what's going on with the shelter costs? It doesn't make sense to us. And they said, well, the city of Detroit had negative rent inflation this month. I said, what? How do you have negative rent? How is this possible? And they said to us, well, when you have eviction moratoriums and rent moratoriums, there's no rent paid. If you don't pay your rent, there's no rent inflation. So if you paid $1,000 a month last year in rent, and you paid zero this year, your rent inflation was negative 1,000. And that's when all the light bulbs went off for us. We said, oh, wow, we're going to anniversary negative oil, on a year-over-year basis. And you're telling me that non-payment of rent is currently holding down shelter costs? I was like, this is about to go wild. Inflation's about to go wild. And we came out with this call, and, so many people, it's just, you guys are nuts. There's no inflation. Demographics don't support it. And I was like, well, let's break out a pen and paper and let's go through the math. And you could figure this out on the back of a napkin. You could figure it out. Eviction moratoriums are going to end on this date. Rent immediately goes from zero back to 1,000. And now, so then there's a layer on top of that, which got even more interesting. The Dallas Fed published a study, and in their study, they said that they did a historical regression of home prices to rent prices and to owner's equivalent rent. And their argument was that rental costs are going to go up 6 to 8% a year for years to come, because the rental costs have to catch up to the housing market. So then that's when we went from, okay, this transitory is like nonsense. I mean, this is a multi-year cycle for inflation. And the fact that on this day, today, right now, the Fed is still buying mortgage-backed securities. It's almost a dereliction of duty. It's just that irresponsible, to be quite frank.
Explain that a little bit more, though, Richard. On the mortgage-backed security, because a few people are picking up on this, actually.
Yeah, so I mean, it's just, there is a buyer backstop of agency debt. When you take out a mortgage, it doesn't sit with your bank. It gets packaged into a loan and, packaged into a security, and it's sold off into the market. Well, the Fed is there buying those bonds. So it creates an incentive to keep mortgage rates low and keep packaging up bonds and keep selling them to the Fed. And, and and then from a hedge fund perspective, this is great. I could leverage up to the moon buying mortgage-backed securities because I know the Fed has my back. Last year, the Fed bought more mortgage-backed securities than there were new homes sold. I forget let's just say it was $100 billion, whatever the number was. I forget the number, but the Fed bought 37% more mortgage-backed securities than new homes were sold in value. So the entire housing market is essentially the new housing market plus an additional is being funded by Federal Reserve purchases. And they're still doing this with home prices up 18 to 20% year over year. I know people, luckily I own a home, but, I know people who don't, single family, incomes, and they can't buy. They're getting beat out, overbid multiple times. It's just not a sustainable policy.
Yeah. And I wonder, we're going to take a quick break, but I wonder almost how we got here. And then what will be the implications of this? We'll take a quick break. We'll be right back. So, Richard, I just want to get back to, why it matters that the Federal Reserve is buying all these mortgage-backed securities, and what kind of impact that has on the economy and housing. So we were kind of tying all this back into shelter costs going up, and I don't know that I understand why that's happening as well.
Well, I mean, if you think about it, if the cost of everything is going up, your home insurance, your home, the ability to sell a home or rent it out, right? There's a trade-off there. You own a home, I could rent it to somebody or I could sell it. So the only way you're going to continue to rent it, because you could sell it for much more, you sell it for 20% more than you could have last year, was if you raise rent prices. So the market clearing rental price has to go up by default, or else people would just dump all their homes. So what the Fed did with QE, in a lot of respects, it's a valuable tool. Like if you think about the Great Depression, if you owned a home and you owed $100,000 on the mortgage, and the home is only worth $80,000, you're in the hole $20,000. If everyone tried to dump, banks blow up. It's a very bad scenario. So QE is useful to inflate asset values, to create, to offset that deflationary spiral. The deflationary spiral has to do with asset values. That's where the big confusion seems to be. And I'm shocked by this. Deflation in the price of goods. If you go to your supermarket and you pay 10% less for whatever, groceries that you buy, that's a positive. That's an improvement in your standard of living. And so the Fed is fighting the wrong deflation. There is no asset deflation right now. Assets are going up. There is no rational case for QE at this point in time because asset prices are rising. So the Fed has to make a choice now. Now that this inflation has kicked off, they have to make a choice. Are they going to choose assets or the standard of living fighting inflation? And, I think this is probably the beginning of a bear market. I think the Fed is way, way, way behind the curve, and they need to catch up. And there's so much leverage out there in the system. And then once the cost of financing goes up, the price of assets should come down. It's going to be so hard if we're right on CPI approaching 10%. Yeah. It's going to be so incredibly hard for the Fed to engineer a soft landing where, stocks are stay where they are. It's going to be extremely hard. They have to kill a beast, and the inflation beast is out of the cage right now.
Wow. Do you think though that, the Fed, and I know they're not a political body, but will they be politically motivated to, in some ways be the bad guy and raise rates? I know I shouldn't say be the bad guy because it depends on which side you're on, right? But
sure.
So it's not this, maybe not a fair characterization, other than, if you have a pension fund or whatever, and equities are going down, if they in fact raise rates, a number of times. The question too is like, how many times do you think they actually have to raise it, or by what percentage points?
Well, I think you'd have to get 100 basis points on the Fed funds rate almost immediately to really. That's
not that much, Richard.
You would see a lot of 100 basis point hikes ever. And I think what it's more going to be like is you'll get a hike in March, you'll get a hike in June, we'll sit and watch for a little while, they'll accelerate the taper a little bit, is what I'm kind of expecting, and that's going to keep inflationary pressures still underlying in the system. So there's a swing thought that we have. I don't know if you play any golf, but amateur golfers have. When they approach, the pros will tell you not to have a swing thought, but you approach the ball and it's like, maybe I need to do something different with my grip, or I always make a mistake with my left elbow. So, amateur golfers will approach a ball with a swing thought. So our swing thought for 2022 is that every time the Fed raises rates, the alternative to holding assets improves. The relative kind of trade-off between keeping money in cash and buying stocks on margin or whatever improves. So as the short-term interest rates hike, so the prime rate follows it, prime brokers increase their charges to hedge funds. At the margin, particularly for leveraged investors, it's going to become less and less advantageous to hold stocks, particularly speculative stocks, on leverage. So you want to think about that. You want to think about, do the companies that you're buying now, that they have cash flow, do they have dividends, they have a return of capital? Because if all of your growth is out there 20 years in terminal value, that's going to get discounted.
We'll take a quick break and pick it up on that note. All right. So, Richard, I'm hearing from you then that you believe rates will be going up. They should be going up because we've got the potential for double-digit inflation. So when it comes to investing then, what does that mean in terms of where you want to be positioned? I'm assuming it's not owning the FANG stocks.
I think you want to be more conservative. It really gets into the financial math. The further out the story is, if it's the company's going to have lunar landings on Mars or whatever, the more as rates go up, the more you have to discount it to the present. So the more speculative a stock is, the more risky it's going to be as rates go up, the more chance for it to go down. So you want to just look for stocks that are, switching back more to value, thinking about things that pay dividends and, have a return on equity, things that you get a more immediate return to you because the present value is going to matter. And that's how you want to think about things. If you think about it, if the cost of capital is, essentially zero, central banks all around the world, heck, in Europe, the cost of capital is negative, you can invest in anything. There's really no downside. There's no cost to financing the trade. But when the cost of capital goes up, now you have to think about it. What's my return on investment? What's the beta of the stock? How risky is this? Am I getting enough of a return to warrant the capital outlay that I'm now paying for? And this is a concept that we haven't seen, in probably a good decade. I mean, if you really want to think about it, you can go back to 2008 when we started printing all this money.
Yeah.
So
but you really do believe, Richard, because this is what's so difficult when we think about investing and our investments, that there will in fact be a paradigm shift, because we've had so many fits and starts with the U.S. Federal Reserve, regardless of who was in charge, think that they were going to raise rates, then no, then yes, then no. You think that this is the time it's going to happen?
Well, I think two things have happened. One is inflation is now becoming a political issue into the election. If there is one thing I would say we didn't anticipate was how, I always thought the Fed was kind of independent. This recent event with inflation going up and the Fed, nobody even questions them. I've now realized the independence is not there. It's far more political than I ever. It literally wasn't until senators were complaining about inflation. You had the whole Joe Manchin issue where he didn't want to do more stimulus. But it wasn't until then that the Fed took the inflation seriously. That's when they dropped the transitory word. And so you've got that political element. You also had Powell needed to get reappointed, and now that's happened. So he's been reappointed. He's got the job. Nobody's questioning whether or not he's going to keep the job. So he can be more of an independent thinker because the political side of it has moved more towards proper Fed policy. And the second thing, if you want to get conspiratorial, is the Fed has been revealed to have a trading scandal.
Really?
And I think maybe at the margin, someone out there, somewhere in that institution, was wondering how much policy changes might impact themselves. And I hate to say it, but it's been multiple Fed governors resigning now.
Yeah. What does that mean to our viewers?
I think you got to play it very cautious this year. I wouldn't be surprised if we've seen highs in stocks for the year already. I wouldn't be surprised. You're going to be running into, they say don't fight the Fed. That's, a long-standing statement on, on Wall Street. This year, the Fed is telling you we are raising rates. We are reducing the balance sheet. You want to, be buying speculative stocks into that? I don't. I think you got to play it very safe this year.
Just quickly, what does that mean for commodities?
I think we're probably peaking in commodities. I think if the Fed does its job and does it properly, the commodity trade is open, and it's had a heck of a run. But I'm to the point now. You have to show me. I want to see them actually do this, because there's been plenty of chances now for them to address the inflationary problem, and they didn't. So I want to see it now. Show us what you got.
Is there anything you are buying?
Oh, there's a lot. If you want to look, in an inflationary environment, you got to look for companies that have pricing power. I can't get into companies that I would buy, but if you look at the tech sector, right? Do you want to own the speculative story stocks, or do you want to own stocks that have, very solid businesses and have easy access to capital? Things like that. For sure.
We got to leave it, Richard. We got to leave it there. Thank you so much.
Thanks for having me on. This was so wonderful.
Thank you.